Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for March 2025. Well, it's certainly been an interesting start to the year for the tanker market. Starting with rates. Rates at the end of 2024 and going into the start of 2025 were quite weak. We didn't quite get the supportive factors from winter market seasonality that we usually do. And what we also saw was that Chinese oil demand and oil imports were relatively weak going into the back half of last year, which put pressure in particular on the VLCC market, which then put pressure down on the Aframaxes and Suezmaxes. However, we have seen a return of some rate volatility since the start of the year, and the main catalyst for that was the imposition of sanctions against more than 150 tankers servicing the Russian oil trade on January 10th, and efforts to put more sanctions on Iranian crude oil exports as well. And that has meant that it's been harder for those countries, Russia and Iran, to get their crude to China and to India. And so those countries have had to look for alternative sources of crude using the non-sanctioned fleet. And what we've also seen since the start of the year is that the price differentials between crude oil in the Atlantic and the Pacific has been such that it's been attractive to bring oil long haul from the Atlantic to Asia. In fact, if we look at crude oil movements from west of Suez to east of Suez in February, they were the highest in about a year. So that's really benefited long-haul crude oil trade movements, which has benefited the VLCCs and the Suezmaxes in particular. We haven't seen as much movement on the Aframax rates just yet. So looking ahead to the rest of the year, what do we expect? Well, starting with the fundamentals on the oil side, it still looks quite supportive for tanker demand. If we start with oil demand, global oil demand is expected to grow by about 1.3 million barrels per day this year and next year, which is quite a healthy level of demand growth. It's similar to what we were seeing pre-COVID, and it shows that we're not seeing any demand destruction yet from, for example, the increasing use of electric vehicles and so on. So it's a healthy level of demand growth, but more importantly for the tanker market, we should see quite healthy levels of oil supply growth this year and next as well, particularly from non-OPEC countries in the Americas. So a lot of the growth in supply this year and next will be driven by the United States, Brazil, which has a number of FPSOs coming online in the next year or two, and Guyana and Canada. And so because a lot of that oil is, as I said, Atlantic-based, but the demand is growing in Asia, that should facilitate the long-haul movement of crude oil from west to east, which will continue to generate tonne-miles. And then looking at the fleet supply side of things, the pace of new build orders will increase this year as this order book starts to deliver, particularly in the Aframax and LR2 segments. But at the same time, we've got a rapidly aging tanker fleet. The average age of the tanker fleet now is almost 14 years, which is the highest since 2002. And if we look just at the Aframax and Suezmax sectors, there's an order book of about 300 ships which deliver between now and 2028. But at the same time, there's about 300 ships which will turn age 20 over the same time frame. And on top of that, there's already 300 ships which are already age 20 or older. So if there's no scrapping between now and 2028, you're going to have 600 ships in the Aframax and Suezmax fleets alone over the age of 20, which is about 1/3 of the fleet, which would be quite unprecedented. So we've got this very large pool of old ships, which at some point will have to exit the fleet. And we think that that will act as an offset against the order book and ensure that fleet growth remains relatively low over the next 2 to 3 years. So from a fundamentals perspective, if we look at the oil side of things and the fleet supply side of things, we think that it looks like quite a balanced market over the next couple of years. However, I think what will really influence the market are some of the geopolitical factors that are going on right now. We know from experience that these are the factors that can really move the market the most. And it's a very dynamic and complex situation right now. There's a large number of geopolitical factors which are likely to play out over the course of this year and going forward, which we think will have a big influence on the freight market. So just taking some time to talk about a few of these, starting with the war in Ukraine. This is a very dynamic situation, and I'm not going to try and predict any timelines as to when the war might get resolved or when a peace agreement could be signed. But clearly, if it does happen, and there are signs that it's moving in that direction at some point, then we could see sanctions lifted, which would have implications for the tanker market. So there would be two main implications there if sanctions on Russia were lifted at some point. One would be a potential change in trade patterns. Since the Russian invasion of Ukraine, we've seen that Europe has stopped importing Russian oil, and all of that Russian oil is moving long haul to India and China. So if sanctions were lifted, we could see some changes to Russian trade patterns, which could have a negative impact on tonne miles. But at the same time, we need to bear in mind that over the last 2 to 3 years, we've had this build-up of a very large fleet of vessels, the so-called dark fleet, to service Russian trading, which is a very old fleet of ships. So just looking at the Aframax and Suezmax sectors alone, we have about 450 ships that are either sanctioned or are dedicated to Russian trading. So that's about a quarter of the fleet. And as I said, it's a very old fleet. About half of those ships are over the age of 20. So if the sanctions were to get lifted, we think a lot of those older ships that are servicing the dark fleet would struggle to reintegrate back into the regular fleet. And so again, there's this pool of very old ships in this dark fleet, which if sanctions were lifted would no longer be needed. So we think the removal of those ships would act as an offset to some potential changes in tonne miles. But exactly how that plays out is quite uncertain at this point. The second point to make is the ongoing conflict in the Middle East, in Gaza. So since the start of the year, the Houthi group in Yemen have said that they will stop attacks on shipping in the Red Sea while the ceasefire between Israel and Hamas holds. So far, though, again, it's a very kind of dynamic situation and a precarious ceasefire in the Middle East there. So far, we've not seen many ship owners return to the Red Sea and try and transit through. But at some point, that could happen later this year, which would probably have an impact in particular on the LR2 market, because that's the sector where we've seen the most diversions away from the Red Sea and around the Cape of Good Hope, which was a pretty good generator of LR2 tonne miles in 2024. So if we see ships return to the Red Sea, that could be negative for the LR2 sector. But again, we're not seeing any signs of that just yet, and I think it will take some time before that happens. Turning now to what's happening on the front with tariffs. Again, it's a fast-moving situation, but what we've seen in February was that the United States announced tariffs on Mexico, Canada, and China. The tariffs were due to be 25% on all imports from Mexico and 25% on all imports from Canada, with the exception of energy, which was to be tariffed at 10%. And then there was 10% tariffs on all imports from China. However, the tariffs on Canada and Mexico got delayed by 30 days to the start of March. At the start of this week, those tariffs came into force, although just today, just a couple of hours before filming this video, it's been announced that the tariffs on Mexico have been paused again for another month, and discussions are ongoing with Canadian tariffs. But if those tariffs do come in, it could have some impact on trade patterns. Canada and Mexico are responsible for about 70% of total US crude oil imports. So if that oil is suddenly more expensive for US refiners, it may get diverted elsewhere, and the US refiners would have to find replacement barrels. In the case of Canada, most of the Canadian flow to the United States is by pipeline, and there's not a lot of alternative export routes for that oil. So the bulk of the oil will probably still flow into the United States, but there are a couple of options for Canada to send more of its oil away from the US. And the prime location there is the Trans Mountain pipeline, which comes out here in Vancouver. So since the start of last year, when the Trans Mountain expansion went live, we're seeing about 20 to 25 Aframax cargoes per month loading, and typically about 10 to 12 of those go down to the US West Coast, and the rest goes long haul to Asia. If these tariffs do come into force, we might see that the flows to the west coast of the US go down, and more oil getting directed to Asia, which would be positive for the Aframax market in the Pacific. They're also discussing potentially doing nighttime loading and transits out of Vancouver, which hopefully will allow them to increase the number of loadings from the sort of 20 to 25 per month range now, up to 30 or above cargoes per month. So again, that could be positive for the Aframax market in the Pacific. And then with the Mexican exports, at the moment, a lot of Mexican exports flow to the US Gulf on an Aframax. With the tariffs, if they come in next month, that oil may get directed elsewhere, which would primarily be to Europe or to Asia on a Suezmax or a VLCC. So again, it would be positive for tonne miles. So some of these trade pattern changes, could end up being positive for the Aframax and Suezmax markets. However, I think in general, if we think about tariffs and trade wars, the longer this goes on, and certainly if these trade wars escalate on a global basis, then it could start to have a negative impact on oil demand, because in general, global oil demand is quite highly correlated to the global economy and trade. So if we do start to see a reduction in trade because of these trade barriers, then over time that could start to be negative for oil demand. And then finally, we've seen some legislation being discussed in the United States recently about punishing some of the Chinese maritime practices which the US government feels are unfair. So this legislation is still being discussed, but it could take the form of charging a fee to Chinese companies calling at US ports, or non-Chinese companies with Chinese-built ships, with potentially extra fees if you have ships on order at Chinese shipyards. So again, we're not sure exactly how this legislation is going to play out and what form it's going to take, or even if it's going to come into force. But clearly it will have an impact, given that about 20% of the global tanker fleet on the water right now was built in China, and about 70% of the order book is at China as well. So certainly if there are fees for Chinese-built ships coming into the United States, it's going to again cause some dislocations, because probably Chinese-built ships will shy away from calling into the US. So it's going to cause some redistribution of the fleet, which generally causes some inefficiencies. But again, we'll have to wait and see how that legislation plays out. So in sum, we're still encouraged by the underlying tanker market fundamentals. We think from an oil market perspective and from a fleet supply perspective, the next few years still looks quite positive. But we do know and acknowledge that some of these geopolitical factors are going to have the biggest influence on the direction in freight rates. And we're not quite sure if they're going to be positive or negative. It will depend on when and how they play out. But we do know that these kind of disruptions and inefficiencies, they generally create more volatile spot tanker markets. So we do think that we'll see some volatility in the coming months, depending on how all these factors play out. So that's our update for March, and we'll speak to you again next quarter.